Welcome to the Broken Pie Chart Podcast, episode 248, a post-Thanksgiving Day extravaganza. I'm your host, Derek Moore. With me once again is my semi-permanent co-host, CEO of Zega Financial, Jay Pestrichelli. All right, Jay, shortened session today, but we are not short on content, and I know a lot is going on.
And I am long on stuffing. I should have gone long stuffing because I ate a lot of stuffing.
It's tough to decide where you're going to really focus. So it sounds like, if that was a pie chart, your allocation to stuffing sounds like it was a little outsized.
It was, but I also had pie. So there's pie in my pie chart.
I see where you're going with that, and I like it. Jay, I also like the fact that we get to talk about Dave Ramsey a little bit. I mean, I don't know, but apparently it's a big deal in the Twitter sphere, X sphere, and YouTube sphere. So Dave has a show where people can call in, and I don't know what he does. I don't really listen to him or watch him or anything like that. But what he said the other day is this caller gave him a call and said, okay, I have a question on the safe withdrawal rate. It's like, okay, is 4% safe or 5.5% safe? And he said to Dave Ramsey, I saw an article that is on your site. It's 4 to 4.5% as safe withdrawal rate. And I guess somebody who's normally on the show, some guy named George, he did a video that said, it might be 3%. So Dave Ramsey went nuts. And he said, look, if you could do 8% forever is what he said. I'm using his words because I did watch it. It's a 9-minute clip. And he said, if you have good mutual funds earning 12% a year when the market is averaging 11.8%, don't know what time frames he's using there. He says, look, if inflation is 4% and you're making 12, you're left with 8. You can always take that out. And he said a 4% withdrawal rate is stupid, only done by super nerds with calculators who don't have any money but only have theories. I mean, I don't know where to start on this one.
Derek, I want to start with super safe mutual funds that average 12% a year. Why don't we all just do that? Of course, Dave Ramsey. Where is he getting this concept that that's the average market return? How is that right?
I don't know. I mean,
at all.
Real quickly, we could say, okay, I mean, I don't know what time period this is based upon. If you go back to 1928 and there's a difference between the average return versus the compounded annual growth rate, what you actually get, and anyway, yeah, let's start there. Like there's so many things to dig into. I'll let you go first.
No, that is a big one for me. The other one is, inflation and you got 12 and the equals 8. Like I'm not, so I'm just a little baffled that he would go this way because he's typically fairly conservative on information like this. By the way, quick little story about Dave Ramsey for me personally is that when my book Buy and Hedge, the 5 Iron Rules for Investing Over the Long Term, went to number 1 in the investing category, it was his book that I was ahead of. I say the authors, me being one of them for that book. So I don't know. I always feel like, we got you, Dave. But that's besides the point. He does sell a lot more books than we do because of his classes. But Derek, I don't know, I'm just digesting this. Like that seems like not great advice, right? You have the thing I always think about when it comes to withdrawals is it's the sequence of when you take those withdrawals, right? There's a terminology we use in our business called sequence of withdrawals. And essentially what it tells you is, and we've talked about this before, the riskiest time of your investment life is the day you retire, because at that point, you're now no longer putting money in to the pot, you're taking money out. And, you can have some really bad timing with the markets and, you're taking money out in a declining market. And if you're taking too much out, you can't recover that. I don't know if you know this, so maybe I'm going to take a little step back. The end number of what a portfolio has is irrelevant to the order of returns of the market. So it doesn't matter. Let's say the market is up, 1% through 10% for 10 years, right? It doesn't matter the order that comes. You end with the same number, right? You could have the 10 first and then a 1 last, or a 5 first and the 6 last. It doesn't matter. So if you had 10 years and each year was, 1%, then the next 2, then the next 3, all the way through 10, it doesn't matter that the order of those things, you end with the same amount of money, right? That's the way the math works. But when you're taking money out, now it matters. Now it matters because recovering from those losses is you can't make up what you've taken out depending on the order that it happens, because you're reducing your balance all the way through. So in our field, we call this sequence of returns. And so the sequence of returns and withdrawals, what do we call it? Sequence of withdrawals? No, I don't remember what we call it. I got myself all backwards. But my point is that you take too much out and you don't have a straight 12%, even if it's this world that Dave Ramsey in that says good mutual funds produce 12% a year. I'm not sure what world that is. Again, even if that happens, the sequence by which you take that money out will cause us to fail, right? It could be potentially too large. So it's too much of a projection of how much I'm going to call it principal. It's not really principal. Your principal makes. And second, taking too much out can be really detrimental in those years when it goes down. So I would actually say that's pretty, poor advice to tell people, like, count on 12, so take out 8.
Well, we did a piece at and I can link to it, but you might remember January of 2020. I did a piece and I put it on the Zega site. Yeah, I'll link to it because people can see it. And I said the S&P total return compounded annual growth rate by decade. And what you find is the 2010, so that's January 1st, ending December 1st, 2009, whatever it was, the market was up until December 31st, 2019. And the compounded annual growth rate, including dividends, assuming they're reinvested, was 13.33%. Okay, really good. The 2000s decade was an average annualized, and that's average annualized return or compounded growth rate. It was like minus 1% was your average annualized compounded growth rate for the 2000s. 80s and 90s, I won't go through all of these, but 80s and 90s, if you go, it's like 17.68 for the 80s, 18.30. The point is, Jay, that you never really know if somebody retires and they're withdrawing money, like what they're going to get. If they retired and you had the 80s and the 90s, okay, probably pretty darn good. If you retired in, December 31st of 2000 or 1999, probably a rough go over the next 20 years because you had major drawdowns, Jay.
Yeah, not so good. And actually, your net returns are negative in that scenario, right? If you're just straight up market returns. So minus 1% a year, like you said. Yeah, 60s, 70s on your chart, you got a 7.8, a 5.8 in there, right? So like when you look at these time frames, Derek, you're right. It's, if you could tell me the decade that we're going to average 19%, great. That I'm going to do something different in that decade than the minus 1%, right? So, yeah, I think this is all, kind of, you didn't comment on Dave. I'll let you comment on Dave. It irks me sometimes when people say things that could get somebody in trouble. And somebody as well followed as Dave Ramsey.
I disagree with some of the stuff on the investment side for him. And I disagree that everybody should pay off their house. I know it's a sort of a contrarian take, but that's one of those things where if you pay off your house, and we've talked about this with new retirees too, where they take all their assets and they pay off the house. Well, then you have all your money in an illiquid asset, and the only way to get it out is to take a new loan. But when you're retired, you're not making as much, so it gets a little. The other thing too is that I was just thinking about this, Jay. Somebody who's retired, he's implying that I'm not saying implying because he's giving an equity type return that you're 100% in stocks as a retiree. Like that sort of flows against everything on the advice. I mean, and you and I would probably say that this is me personally. I don't like the target date funds. I don't necessarily think that people should be in as much bonds as they are. But really, you're going to be 100% equities unhedged? Okay, right?
It's a good point. It's definitely another additive point. That's if like, yeah, right. You're in retirement, sure, buy the S&P, own equity risk, right? Like we just saw what equity risk could do to you last year. We also saw what bond risk could do to you. But in all fairness to bonds, and I'm usually not very fair to them, but in all fairness to bonds, that was a unique year last year. It wasn't unforeseen, but it was a unique year and what happened. So, but like, I don't know, what's the bond fund that's going to make you 12% a year?
That's right.
I'm waiting to find out.
And in 2008, even the AGG got hit because it had more MBS, mortgage-backed securities, in there. And for my book, Broken Pie Chart, shameless plug, you got to plug yours, I'll plug mine. By the way, what great books to buy. We're getting into Black Friday. We're getting into Christmas season. I would buy each of those books. Buy 2 copies. Keep one for yourself, give one away. But I had in there target date funds that were down 30 to 50%. And without and not even a retirement date that was too far out in the future. So anyway, but the other thing too is, and I'm glad you brought up that point about the sequence of returns has no bearing of the order as long as you aren't taking money out. And I'll also add, if you're not bringing money in. If you're bringing money in or taking money out, the sequence does matter. But I think the point too is that, look, I mean, if you have a minus, imagine a 2008 type year where you're down 37%. So, okay, now you're down 37%, and then you take money out. As you're taking money out, as the markets recover, it's doing so on a lower balance. So, yeah, I don't know. It doesn't make any sense to me. I don't know where he's going with this.
Maybe that's why I passed him in, when my book was released.
I'm sure his is still above both of ours combined. I'm sure. His podcast is certainly above the Broken Pie Chart. I think so the way they do it, I mean, there's sort of like a business category and there's there's like an investments category. I don't know, but his most certainly is, I'm sure, in the top 10. Ours is not, although we do break the top 250 here and there. All right, so what else can we go to? I think I'm done with this. I mean, by the way, though, I was thinking about this because I was like, okay, well, maybe
so
I'm not done. It just we should just do an anti Dave Ramsey podcast one day, and we just go through everything that he recommends. No, the house thing bothers me too. I'm like, not everybody should pay off their house. It just there's good debt and bad debt. I mean, it's
of course.
And it's a whole other thing with, if you don't pay off the house, like, are you buying speedboats with that money or are you investing it? But Jay, I looked and I said, how have the markets done since, because I don't have the decade yet for the decade to date, I guess we'll call it. And so if I looked at the markets, the first day of January 2020, we're now November, 24th of 2023. And I don't know. I haven't done this for a while. The markets are up about 40% on a cumulative basis. And if you do the annualized compounded growth rate, that's probably high 8% right there. And with dividends, it's probably over 10%. I just doing this quick math. Jay, I guess I would put the question to our listeners, and I know you know the answer, but if I asked everybody, hey, are you really happy with since January of 2020 with your investment returns? I'll bet you most people said, no way. But you're getting, I mean, that's pretty good return. That's a really good return.
Yeah. And look, 2020 and 2021 were monster years, obviously, right? I said monster, right? They were strong. And then, we had last year, which was the opposite of that. And so I think there's this, psychological hangover from that. Derek, if I asked people how they felt about their returns this year, I'm not sure if they would feel good about it, right? There's been a lot of turmoil and a lot of headlines, but you know where the S&P is for the year? Like how what it's up?
Actually, what point? Is it? I'm guessing it's between 15 and 20. I think.
Yeah, I mean, just the index itself, the S&P index itself is up just over 18.5%, throwing dividends, and you're knocking on the door of 20%. The market's up
Nobody's happy.
20% this year, Derek. Nobody's feeling like, wow, it feels great to be invested right now. At least the folks I talk to, at least, I will say I haven't had anybody calling me to discuss their fear of, of why they're down so much this year. But I would say, like, this has been a really strong year. When you I don't know in the hierarchy of where it is, but if we end at 20% for the year, it's kind of great. I don't think anybody was really counting on that. I know from our end of year predictions last year, I don't think anybody was, even our most bullish wasn't at a plus 20.
Maybe our most bullish person. I've got to figure those out soon. We'll share those with the audience, and we'll be up to do them.
Yeah.
Don't you think too that a lot of times investors are fighting the last battle, meaning they probably adjusted their portfolios, especially, people doing it on their own. It's just a generalization, but it's really hard. And to stay, emotionally or not get emotional about the returns and say, well, 2022 is bad. I'm going to go into the money market. I'm going to hide out there. That's a better thing. No, market's up 20% this year. Or maybe people will eschew bonds, avoid bonds altogether forever now. And just because they were down. Like, I think a lot of times investors are fighting the last battle.
Yeah. I mean, you don't forget it. That's what's most fresh in your mind. So I don't think that's wrong. So anyway, back to the interesting year that we're having, right? And as you're going through the decades here and the kind of the average returns, it has not been, a terrible market since the beginning of 2020. And remember what has happened in there, right? Fastest market decline in February to March, right? Market dropped 35% peak to trough in a period of 3.5 weeks. We all lived through that. Then you have this historic, bond decline that we experienced last year. Like, there's definitely been some turmoil and interesting times. And to say, look, on average, still up 8 to 10% in equities, it's pretty great. And I would say that was a hard fought 8 to 10% for everybody, right? It took a lot of, if you were someone that was watching and staying in touch pretty regularly, it probably didn't feel great. So, but you look and you're like, oh, not bad, but still not 12%. As we already talked about that part before.
Oh, it wasn't 12% so far. Huh, that's weird.
It's not 12%.
I mean, it could be, it couldn't be.
I want to find that world.
Could you imagine, like, let's say you had somebody, December 31st of 1999, they decide they're going to go off the grid, go backpacking in the mountains of the Chilean mountains, and they're still there. And and then you have somebody who's been watching intently CNBC every day, 8 hours a day. Like, that person will come back and be like, oh, cool. All right, great. I'm up 40%. The other person's like, oh, this has been a horrible market. Like, yeah.
Right? Yeah, I think that's true, right? It just kind of goes to show that you got to kind of keep the emotion out of it, right? I mean, we talk
sometimes
about
it's
that
hard
a lot,
to do nothing.
Sometimes
it's really hard to do nothing. In fact, look at the 2000s when the average annualized return was down. You lost essentially 1% a year. That same scenario, the guy who goes into the mountains of Chilean mountains and somebody who's watching it every day, they'd come back and then they'd say, why am I down 1% every year? Oh, wow, all that happened. Cool. I'm kind of flat, but I'm glad I didn't lose more. Like, I think the hard thing sometimes for investors is to do less. Do less. Do less of what you think you need to do. So anyway.
Yeah. Yeah, I agree. All right, we'll move on from this.
So
next thoughts.
I saw a chart. This was on X from Isabel Net and a source, Goldman Sachs. Jay, you have a problem with this chart, but let me just explain it for the listeners. What it is it's the S&P 500 seasonality from 1950 through 2022. And it's the idea of in an average year, a market's up certain points, certain months of the year. And then we're only through November, wherever we are right now, wherever they did this. And they're saying this is sort of from a seasonality basis, you typically see a surge near the end of the year. So I don't know. Did we already see that surge in November?
Well, November was pretty great. So that's true. So let me talk about this chart for a minute and explain to you why I don't love it. I am someone that believes that seasonality certainly exists within the market. We see it all the time. And sure, that exists. And in this chart, I guess it looks at, the average returns. Hey, it has kind of the average at 9%, Derek, seasonality since 1950 to 2022. Says the average, it shows like the average path of the market to its average of 9%.
Oh, it's not 12.
That's not 12
but
as far as I'm
that's
concerned.
Not the right mutual fund. Apparently you needed the plus 4% mutual
they
fund.
didn't have the good mutual funds in this stuff. So, and look, it's strong in the first quarter generally, right? You got this flattening out even through the second quarter, strong, and then this flattening of the third quarter, and then strong fourth quarter. Yeah, look, in our time of investing, we've absolutely observed that. And when you look at this year, the peaks are higher and the dips are lower, but it still follows along that path, except for the point that this year we just said we're already up 18, 19, 20 for the year. And this chart is kind of, I would say, purposefully reducing down that magnitude to fit what is happening on the average. So this is something, Derek, that you and I would call a chart crime. I am absolutely flagging the chart crime for this year, that this should show that we are double what the market does on average. Now, seasonally, it is following a similar path, although it got way ahead of itself in July. And then the dip that we saw for September, October was pretty dramatic, down way below it. So I don't know, like if we were going to finish at 9%, I would tell you we're in for a rough December. I'm not saying that, but just my point is, like, this year is following the seasonality, but this is also an extreme year that's already well above what the average year looks like from how it goes month to month. This must be even day to day.
Right? I don't know.
I have to do the math on this. So, because it looks like it's...
So I guess what you don't know is, have we already made the move and we'll be flat? I mean, who knows, right? We don't know this, but yeah.
That's right. Like, did we get this big, pop up in November? That was the pop that you could see sometimes in December, right? I do like the smoothness of the December line, Derek, right? It looks, generally speaking, from seasonality perspective, that December is a fairly smooth, market. And actually has a nice little angle to it up into the right? So it looks good. I mean, does that tell us seasonally there's low volatility in the market from this point on for the rest of the year?
No, it is possible. Now, Bloomberg had a chart, and they said the S&P 500 tracked one of its best November gains on record. The index has gained more than 8% in November, fewer than 10 times since 1928. So this is going back to 1928. And we're up greater than 8%, according to I don't know when. Yeah, this is as the close, November 22nd. So that was Wednesday. So we don't know what we'd have to do the research to see what happens after we have an 8% November, whether that continues on or not. But we'll know when we know, right? I mean, this is the thing with, but over a long enough period, when you average all these out, I'm sure this is a pretty stable chart. So we'll see. You mentioned volatility, though. You and I were fascinated because we watched the VIX Index. We watched the VVIX. The VVIX is sort of the volatility of options on the VIX. The VIX is looking at the implied volatility of options on the S&P 500. We saw something that was really fascinating. Was it 2 days ago? My days are kind of going together, where the VVIX was under 80. And all of a sudden, it shot up. It was just an odd move. And you and I were messaging back and forth, like, what's going on? Well, we pulled up the time in sales, looked at a little deeper on what's going on. Jenna, you were I think both of us were a little. We were looking at what the trade flows were. And why don't you tell us what we saw there? I'll let you take that.
Yeah. So what the VVIX, what the clue was all of a sudden the volatility of the VIX itself popped up, meaning people were willing to pay more in premium for VIX options than they were, just 5 minutes ago, right? So when we saw that pop, we took a look at the where all the volume was coming in, and it looked like a whole heck of a lot of volume on the December monthly, which happens to be December 20th, the December monthly contract for the VIX options at around the 17 and 18 strike. And the point there was that, what we observed was telling us that, there was quite a bit of buying on that 18 strike. And it was because it was costing about 50 cents. And so the idea was that, when you look at that 18 strike option, very few times in the last few years have you seen that VIX call trade below 50 cents. So when when all of a sudden the volume started coming in on that, it made a move in the implied volatility of the VIX itself. So what is, this is one of those things that Derek and I would tell you, some of our highest tuition payments so those of you that listen, you know what we're talking about when we say we paid tuition, came at the education of trading options on the VIX. It is not for the faint of heart. It is not for the inexperienced. And even when you get one or two of them right, in general, it's going to be hard to get them all right. You're going to get more wrong than right trading VIX options. But the idea here is that the reason why somebody would pay. So by the way, VIX was trading at the time around 13, right? The index was around 13 and a half, and they were buying 18 strike options out to December 20th. So they had about 28 days at the time that we saw this volume hitting. And what it tells you is that someone's willing to say, look, I think break even on the VIX is going to be above, for me, 18 and a half, right? They are wagering, betting, I'm going to say, speculating is probably the better word to say, is that the options will appreciate in value between now and December 20th so that they'll be able to exit those options at higher than 50 cents, just like any trade would be. It doesn't necessarily mean they're counting on the VIX getting above 18 and a half, but it has to look like the VIX will get above 18 and a half, and those options will start to increase in value. So, by the way, they have not done so over the next 3 days. So I'll say 2 days. So that day, that was Tuesday, Wednesday, we saw a little pop again today, yes, but still the VIX has actually continued to decline. So, but those options have held their value. They're still around 44 by 49 cents, so slightly lower than where all that volume was on Tuesday. So again, sorry, I'm off on a little tangent here when it comes to the VIX options, but just recognize when that volume comes in, it tells you that somebody is bracing for a pop in the VIX price, the pop in the VIX index, which typically comes from rapid sell-offs. It could also come from, speculation on the put side of the VIX, because the market, maybe can go, the market can go higher and the VIX go even lower. It's down a point since we saw the VIX itself is down a point since the day we saw those go off. We're here at 12.46 on the VIX index on this Friday, the 24th. And it's one of those things. We haven't been this low in years. And so it's not an awful speculative bet to place, but you just have to know how to trade that, right? It may seem pretty obvious out of the gate, but you got to watch for how that VIX ends up marking. And you have to understand the relationship to the futures. And I know, Derek, you've talked about in the past, but that's my general gist of what we observed in the market. And then maybe, Derek, if you want to comment on that, and then maybe we could talk about what even 2 days later, what other trades may look like in that space.
The VIX is, when people see the VIX low, they say it's a great time to buy. To buy meaning you can't buy the VIX. You can't buy the spot VIX, the one you see on CNBC. It's an index. There's no options on it. The options are on the futures. But it's the idea of, let me buy some calls on the VIX. And the idea is, as you said, you pop up, and if it pops up enough, you can be profitable there. But what we've seen historically is that a low VIX almost begets a low VIX, meaning it's, you can't really look at this like you would a stock. Like, it's down at support, so it's got to go up. It doesn't really work that way. So you also don't know, that trade on the surface. And I don't remember what the total. I mean, it was in the millions of dollars. That was a really big piece that was taken down there.
Oh yeah, they spent $10 million. They traded
What
200,000
we don't
contracts
know
for 50
is, are
cents.
they
It was
running
a
a
$10 million.
$1 billion long equity strategy, and they're like, we're up for the year. Let's make sure we don't give back the gains. Well, maybe this is in their opinion, a cheap way to hedge, or it was part of maybe their short volatility, and they said, you know what, we're short vol, but we'll buy this to hedge. So we never really know why they're doing it, who's doing it, but I think what's interesting, and you're going to go there next, is just thinking about how low the VIX is right now, how low break evens are. And maybe you can explain that a little bit, Jay, on let's say if you were to trade one today for December, like where the VIX would have to go to break even or to make money above that.
Yeah, it's like you said, we've definitely traded a lot of VIX in our time, and I've said it, you've said it, and it's one of those things that understanding the relationship to the future. And I'm going to make a minor, I'm not going to say correction because what you said was accurate, but just maybe a minor clarification. When you said there aren't options on the VIX index, it's actually, there are options on the VIX, but those options are based on the pricing of the futures. So for example, it's the only thing I know where you could have negative intrinsic value are options on the VIX index. And it's because they're priced off of the futures, which are a little more predictive than the mathematical representative of the VIX itself, right? The VIX itself is an equation. It's an index. That's why you can't own it. But there are futures. So sorry for that little bit of a clarification, Derek, only because people might be like, hey, I see options on the VIX. I thought you said I couldn't trade it. Yes, the pricing of those options are based on the futures. So there's a few tricks that you can use to figure out if you don't actually know how to see the futures themselves, right? The futures of the VIX. You always kind of look for where the call and put are at parity, where they're the same value. So right now, if you were looking at the December 20th options on the VIX, it's around the 14 strike, right? The 14 call would cost you, $1.02, and the 14 put would cost you about $1.09. So they're about the same. So that tells you the future's probably right around that 14 level. So interestingly enough, so that's the first thing about the futures. The second thing, the interesting thing enough, is when you look at break evens, that actually seems to be the level that if you didn't want to put a small amount of money like that large trader had done on Tuesday, if you want to actually put in a position that had a lower break even, you could, I'm just looking at the prices here, you could buy a 12 strike call. That means the right to sell at 12 for about $2. So if you have a call with the strike at 12 and the premium is $2, your break even is 14. So that means if when the VIX settles, the index ends up settling on, usually it's a Tuesday, right? Is December 20th a Tuesday, Derek? Let me just look at my trusty little I think they still do those on Tuesdays, right? Sorry, you and I have almost sworn off trading VIX options, right? Yeah, it's a Wednesday actually. Maybe that's Wednesday the 20th. So if you think the VIX, the index in this scenario, not the future, because the future will eventually match to the index because the index is the math. If you think it'll be above 14, you could buy this 12 strike call for $2. And if at the end of that period, you would be up the difference between 14 and wherever the VIX landed. By the way, that's not a crazy speculative trade. I mean, look, I realize the VIX is at 12.5, the VIX index is at 12.5. And we've had lots of days this year from June on where the VIX has been below 14, right? You've got periods in the middle of June. You've got almost the entire period of July that it was below 14. You had a little bit of a dip there at the end of August, right, where you kind of stayed below 14, and now you're below 14. So to think obviously the VIX is going to be above 14, it's not obvious. It may seem like it is because it does spend most of its time above that. But to Derek's point a minute ago, low volatility begets low volatility. There was a study that Derek and I used to reference years ago where it was, once you kind of cross certain thresholds, you stay below certain thresholds for a while. For us, we focus on the 16 level and the 13 level as kind of key data points. I should say 16 and 14. We've since modified that number. So, staying below 14 is definitely, I think 14.2 is our number actually. Staying below 14 is very, very possible. So while it doesn't feel like a bad trade to buy the 12 strike calls between now and December 20th, there's absolutely nothing that's a lock. We could see volatility continue to trick lower. Vol can definitely go down from here. So, just one of those things that we keep an eye on. And it's really interesting as, the VIX is closing at a level that it hasn't seen since January of 2020. Right. So, I don't know. Anything else you want to add to that, Derek? I went down a little rabbit hole.
Yeah. First, I'll just, for the listeners, this is reason number 58. You got to be careful trading VIX. December 20th is in fact a Wednesday. I think you clarified that. The last day to trade those is the 19th. And so what the VIX does, there's sort of an opening. I don't even want to get into this. It's like an opening pricing rotation function on that morning. And so let's say you're like, oh yeah, last day to trade is the day before, and your options are in the money, meaning you're profitable. They can actually change the what's called the settlement price that Wednesday morning, and you could be unprofitable all of a sudden, or vice versa. So it's a little oddity there. And most options these days are, we have a lot of weekly options, we have a lot of daily options. When we get to the indexes, we've talked about those before, and those are PM settlement. Last day to trade them is the day that they expire. But the monthlies on things like the S&P, the old monthlies, and then you have a lot of the VIX options go through that opening rotation. The interesting thing too is, if you think about it, it's $2 and the VIX closed at 1246. That's about a 16% cost. So, think about that. Just put that in your mind. If you had whatever amount of dollars that you're going to put into this, it's 16% you could lose if the VIX goes nowhere, if the VIX settles exactly where it is today. So, it's kind of a rich trade. I know it seems cheap on the surface, but it's kind of rich. But yeah, no, on the same way, Jay, like if there's any blow up in equity markets, any sort of upset, it seems like that would be sort of an interesting trade to have on. Now, I will say there's some seasonality. We talked about seasonality earlier. That week before Christmas and sort of the 2 or 3 weeks before Christmas in December, we used to call it was the kink in the chart of the expected volatility. And historically, and I don't know what will happen this year, but volatility actually really drops in, let's say, a just normal run-of-the-mill year where nothing's really happening. You'll see it kind of drop. In the VIX futures curve, you'll see that little kink where that VIX future, whether it's a week or 2 weeks before Christmas, actually is lower than the rest. So it's kind of subtle, but yeah, I mean, here's the thing too, Jay. Like if you would have told me a couple of years ago, oh yeah, a break even on a monthly VIX option is actually 14, you'd be like, oh wow, yeah, anything happens. That seems pretty interesting. But again, it's your cost is 16% of the to sort of get into it.
Yeah. By the way, interesting going out another month, adding to that trade, right? Like, let's say I took a look at the January 17th options, right? The break even on that one, those 12 strike calls are trading at 375. So now your break even is 15.7. So it's like twice the move up when you double the time, right? So now you're in the 15 range. The future, I'm just looking where parity is on this thing. Yeah, maybe $1. at 15 and a half is kind of where it is. So, again, back to the concept here is now you've got 2 months for it to get above, your strike, but that strike has gone up twice as much. You need it to move up twice as much, right? And the cost on that is $4, right? So doing your math on the cost of this whole thing, it's a third, right? So, sorry,
yeah,
25.
it's a third.
No, it's a third. Yeah. So, yeah. So, we call them speculative trades, and, they're there to teach you a lesson if you get them wrong. Lessons we've learned.
The thing, though, is a hedge. It's with the VIX at these levels, it's easier to hedge than, let's say VIX is at 25 and then you're buying VIX calls. Well, then your break even is much higher. So, that this type of trade is for something that's unexpected, that's coming out of the blue, that's going to really drive fear into the markets. That's kind of what this trade is. So, all right, I think we've gone through this enough. But it was just, I thought it was really interesting. Like, you messaged me and you're like, look at the VVIX. I'm like, what is going on there? That doesn't even make any sense. Because if you can imagine, for the listeners, the chart was like down, sloping down, sloping down, sloping down, and then all of a sudden this little shoot up on the intraday chart. You just don't see that. And the VIX did not move at all. The markets didn't move at all, but VVIX moved. And you and I immediately are like, well, somebody's buying VIX calls, right? So,
yeah, and the reason we were paying so close attention to it was, I think we've talked about some of the option data points and triggers that we watch in the market, is that there is kind of an inflection point at the VVIX below 80. And so, it kind of touched it, dipped below for half a second, and then, we saw that rocket higher. So, there's a reason that 80 is kind of that inflection point for us, and we didn't close below it. But that's why we were watching. And I think, it just goes to show how the options market has its own little dynamic. And, we'll see if this one turned out to be, right or not, which is someone taking a speculative bet on some sort of a short-term sell-off in the market.
All right, last thing I wanted to cover before we get to some recommendations is congratulations, world. Advanced economies and emerging and developing economies, both sovereign debt, according to the FT, Financial Times, is close to historic highs. Central government debt as a percent of GDP. If people could see this chart, you would see advanced economies are probably about 110% of debt to GDP, which means if your GDP is, just rounded off, 30 trillion, it means your debt's above 30 trillion. And then emerging and developing economies are, I'll call it, 70%-ish. So this is one of those things where it's a problem, but I'll let you know when it becomes a real problem. Like, I think it's a problem. I think it's a very big problem. But the hard thing for a lot of investors looking at stuff like this and wanting to bet against, let's say, a sovereign debt, some problem in sovereign debt, is I always joke around and I say, I thought debt was a problem in the 80s. Like, you could be right on your thesis, but be wrong on your timing. And I don't know. If I knew this would be one of the biggest trades ever, if I knew exactly when this was going to cause something to happen, but it's a problem, Jay. And by the way, yeah.
Let me take the other side, because I don't disagree with you.
Sure.
Let me take the other side of this. What do you say to those folks that say, look, we can just always print money, right? The United States can always print money and sell more bonds just to kind of capture all this. Like, can't we just pay off our debt by printing money? What's the problem there?
So we sort of tried this during 2020 and 2021. We sent trillions of dollars of checks to people. We printed money. I could send $1 million, print it up, send $1 million to every household in the U.S., and it would only cause more inflation. So it's like,
would that make the debt go away? Like, I'm saying the U.S. could just pay off all the debt, right? The sovereign debt that it has. And like, why couldn't it just do that? Be like, hey, we have no problem now meeting any of our interest obligations, and any debt that we have outstanding, we're just not going to reissue it. We're fine. We'll always be able to pay our debt because we could just print money.
Yeah.
Like,
but when you print money,
literally printing dollars to put it into the Federal Reserve, and they wire money out. Like, why can't they do that?
The way they do it now is they issue more and more bonds. I mean, that's the way we're doing it now. We just issue more and more treasuries. The Fed stopped buying treasuries, but enough banks take treasuries on, and the federal government takes that money and uses it to pay the interest. I mean, if you actually printed physical, you would destroy the dollar. You would have inflation. But the way they're doing it now is, they print money, but they just keep issuing debt.
But what if everybody does it? But like, no, but what if every, developed economy said, okay, we're all going to print dollars to pay off all of our debt, and, dollars compared to everything else, all the currencies are going to kind of go up equally or drop equally. So we'll keep our relative strength. Why can't we just do that?
You can't really do it. Now, you could default on the debt. You could default. And by the way, all right, contrarian Derek, conspiracy theory Derek would say, you know what? They're going to come out with a digital dollar, and they're going to say, oh, those other dollars and all that debt, we're going to push that off to the side. We'll silo that off. And now we're doing it new. This is the digital dollar, and now all the new debt that's coming out, this is the new currency that we use. And that other stuff, the Fed will just buy it all, and they'll put it on their balance sheet. Like that's, I don't know if it's a conspiracy theory, but that's the, and I think
it's like changing the rules of the game halfway through, though, right? Like that
changes. Like, this is why I feel bad for people who are betting against this stuff, because like, imagine you bet against all the banks going down because of the balance sheets. Oh no, the Fed did it again. They created a new program with a new acronym, and oh yeah, those bonds that are trading at $80 instead of $100, we'll just buy them back at $100. We'll put them on our books. 2020. Yeah, the bond's really, really in trouble. That's okay. We'll buy bond ETFs. Never done that before, but why not? We'll buy it. Japan's been buying equities for years. I'm just saying, like, this is people aren't wrong who look at this stuff, but you have to decide as an investor, like, what is it that you want? And if you want to build wealth, and you want to build wealth for retirement, then you should do that. If you want to, start a movement or, to bet against everything, then do that. But just understand that you could be right on stuff and be wrong, but you could be right and they could change the rules and you'll be wrong anyway. Like, it's a hard.
I think that's it, right? The changing of the rules to me is the big question, right? Like, they're gonna change the rules, right? If things get really nasty, they're gonna change the rules, because I think they feel they're obligated to do the most good to the most folks, and generally most folks are not, shorting the U.S. Economic strength, right? The average Joe doesn't do that kind of a trade, right? So those are big banks, and they'll find themselves on the wrong side of that, or they'll be right and still not get paid, and for a long, long time they'll have to still just wait for them to be made whole. So I go back to the movie, The Big Short, all the time, right? I just think about that, how those guys were right for a long, long time, and just didn't matter, right? Larger institutions just kind of waited until they were properly positioned to then take care of them.
Yeah. No, I'm glad you went there, because I remember Michael Burry his fund was losing money. And you and I both know people who were betting against, not in the same way, but they were shorting housing stocks, in 2005, 2006, saying it's going to collapse. And, the market can stay irrational longer than you can stay solvent. That's the thing. I do wonder, though, we don't have to give this like a 10-second answer, Jay, but I just think about 2008, 2009. Like, if that happens today, do they create a new vehicle or, Fed program to just take on all the toxic debt? Maybe they did that with TARP, but I wonder if they would do it differently and just, I think they would. I think they would just take it all, and I think they would they would buy ETFs.
Of course they would. Yes, the answer is yes. We don't have to go long. Yes, they would. They've shown it multiple times.
Yeah. So that's good luck betting against that stuff. And I say that with all sincerity. Like, you just have to decide, like, what is it that you want to do? And all right, Jay, any recommendations this week?
So I've been doing a little throwback, and so started watching what I would consider a top 10 show for me. Restarted watching Mad Men.
I've never watched it.
Remember that one? Whoa, you should watch that one.
How many seasons?
You should watch Mad Men.
I'm going to look it up.
Oh, I don't know. 7, 8?
Yeah, it's got to be Mad Men seasons. Here we go. 7, yeah. All right, that's a big commitment.
You'll enjoy it.
All right, I might check it out. I mean,
that's my.
Have you watched? What's the one that I watched? Breaking Bad, which I actually wound up liking. Yeah, that's the other one.
I know you told me. I haven't been willing to make that commitment, and I know maybe that's the alternative. I still, we tried, but we haven't tried again since you said get to the end of the first season.
You just have to get to it. And
I know I'm in the minority on this one, by the way. Anybody that's made the commitment has always said the same thing. I just haven't.
Yep. I didn't actually have a recommendation this week, but one of our friends of the program, listeners, Michael, had told me two things to check out. One is Silo on Apple TV, and I lost the paper with the other one. I'd had it, but I'll have to bring that one next week. But that will get you by.
I watched Silo. Not bad. Silo was not bad.
Right. We'll
job,
check
Michael.
that out. Yeah. All right, Jay. Sadly, I think. Yeah, go ahead.
Wait, can I give? No.
Sadly, we ran out of time to talk about the Argentinian presidential race. You got a new guy over there, Milei.
Well, how's he going to bail them out of the trouble they're in? What's he going to do? What's his platform?
Going to get rid of their version of the Fed. They're going to go to U.S. dollars instead of their own currency, and a bunch of other stuff. I'm interested to see what happens because, look, Argentina's defaulted what 7 times already. They borrowed I don't know how many millions of dollars from the IMF. Like whatever you've been doing, it hasn't been working. So maybe you try something else, but stuff will get broken. They'll break stuff. I don't know. We'll see. I mean, so the idea is, when one of the only things that's ever worked, I don't know if it's worked long term, but you create a currency board to battle like hyperinflation. And the currency board basically says, we guarantee an exchange rate of your currency into dollars. They sort of fix it or peg it. And then it sort of stops it tries to stop the hyperinflation. But I don't know, maybe they default on the debt. Just default on it, start over, use US dollars. I'm interested, Jay. I'm interested to see what happens. Start over? So.
All right. They got any? They got some mountains there, right? Can they get any like precious metals? Can they get any like metals that help the EV space maybe out of them?
Did not prepare my my EV mining global maps for this program, Jay, but I will look into that for next time. But all right, that's going to be it for this week. Happy Thanksgiving, post Thanksgiving. By the time everybody is reacting and listening to this. All right, Jay, thanks again. Talk to you soon.